the focus of today's presentation is a little bit forward-looking. We took the call late last year of the market sort of, we call it retreat, regroup, and rebound. I think we've sort of seen the retreat happen. We are in the regroup stage right now, and we are hoping for a rebound in the second half of the year.
We can never guess where the markets are headed, but at least we should be aware of all the factors which are impacting our markets, and therefore at least be prepared for it. There are plenty of ideas which can help you get better than normal returns, besides, of course, the earlier part of telling you what the market is all about.
Retreat, regroup, rebound. Why do we think that? For 2016, I think the risk is that the growth will actually be lower, even lower than this uninspiring 3% we saw in 2015. This sort of environment where low interest rates fail to stimulate growth, demand, and investment was a theoretical concept that originated in the 1930s. The top speed in the US economy is around 2.5%. This is where we differ with the rest of the world. And we also think that there is a possibility of a US recession in 2017. The one solution we need to see in the US and the world is more aggressive fiscal policy.
So the first picture is China's exchange rate fluctuations. So fixing a big reform in August 11th, I'm sorry. And then a big jump of devaluation, then stabilize, and another wave of depreciation after China joined the SDR basket of currencies. So this wave of depreciation really worried the market. China used to rely heavily on investment and export. So if we take a look at investment, so investment used to grow at over 20%. In some peak times, grew over 30%. But now, investment only grew by about 10%. So investment is slowing down. Another engine of China's economic growth is trade surplus. I think China is no longer relying so much on export. And so China's export is not doing so well, but I think more importantly, this is driven by global factors. So what do we need to do in the short run? So we expect that in the short run, fiscal policy will be the main part. So we're going to have expansionary fiscal policy in 2016.
India has clearly outperformed on a relative basis since almost for like more than a year and a half. And if you compare it to several economies in the world, it stands out for an enviable combination of macroeconomic stability. Not many countries can actually boast of it in today's volatile time. Political stability, and let's not forget a very, very well-respected central banker. It's equally true that while on relative basis, India looks extremely good, when you compare India to India itself, or how India should be doing according to people on the ground, we turn out to be an underperformer. We are far, far away from where our potential is. And yes, in the last 18 months, we have seen economic recovery happening at a very gradual pace. Despite the tough 3.5% target, the government or the finance minister has also tried to provide money for capital expenditure.
In our view, the dollar rally is still not over, but we are getting very close to the peak in the dollar. Of course, there's a more fundamental reason as well, and that's monetary policy divergence. If we take a step back and really see what has driven the dollar stronger over the last few years, it's been the Fed first announcing tapering of its QE and then going on with its first Fed rate hike. At the same time, the ECB and the Bank of Japan doing more quantitative easing, and that really drove that divergence, drove dollar higher. So we might be in a situation where the dollar lacks a fundamental support, but at the same time, Asian currencies also do not have a fundamental support for rallying much further. So that it could really be a kind of an environment where markets are more range-bound than trending. And in these kind of environments, we typically see two kinds of currencies do well. Firstly, currencies which have really been oversold, which are really cheap on valuation metrics. And The examples that come to mind are something like Malaysian ringgit, which has obviously been weighed down by a number of factors, political, oil, and that really looks cheap, and that's one of the reasons why Malaysian ringgit has been performing quite well. But the other category of currencies which also tend to do well are those which offer high carry in a range-bound environment, especially with low volatility. Again, the likes of India, Indonesia offer high carry and definitely will benefit from carry-driven inflows.